Everyone, prior to trading full-time, Nick climbed the ranks of the corporate finance world. Then in 2000, he branched out with an internet venture as CFO/COO. The venture paid off well enough to allow him to start his own fund and pursue his passion, the stock market. Since then, he has been honing his skills, profiting from trading credit spreads. Nick considers success when he can identify an opportunity, gauge the risks involved, then finally set it up to yield maximum potential. With that said, Nick, I'd love to learn from you. I'm sure everyone in this room is looking to learn from you, and I'm going to go ahead and let you take it away.
Excellent. Thank you so much for the opportunity. I enjoyed the presenter before me as well. We share some of the same philosophies or views on trading and how to do it simplified and all of that. Let me start the slideshow. I figured I'd show you a little picture of my desktop. And that's actually, I took it one day with when I was out with my son here in California. But anyway, let's start the spreads here. Today we're going to talk about credit spreads, and it's something that I'm passionate about and I enjoy doing. It can be fun, and we can do it in any market condition. That's the main main portion of my day. I dedicate credit spreads, and I want to share it with you to show you how you also can start to dabble in it if you haven't done so already. But first, we have to do some house cleaning, put up the disclaimer that investing is definitely risky if one does it early, and we are going to do some learning today for educational purposes so we can to avoid the pitfalls. So go ahead, take a minute, read that, please. And meanwhile, I will also tell you that I was listening to the presenter, and he mentioned learn, 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 and that's exactly what I like to do. My thing brings up a question, I hunt the answer, I most definitely will come up with a question, I hunt that answer, and that's my learning process. And without that, I would get nowhere. I would not be here. And it all started with one stupid little Excel formula years and years ago when one of my bosses sent me to a class, and it just created a whole funny story. If I have time at the end, I'll share it. Okay, this is me. Thanks for the intro before. You kind of covered most of this. I'm basically from Main Street, not Wall Street. I did not work at any venture firm as far as trading Goldman Sachs or anything like that. I'm an engineer, electrical engineering. I have my MBA, and I enjoyed trading, so I dedicated my time to trading and evolve, and finally honed in what I'm doing. I've been doing for years now. You can reach me on Twitter or StockTwits or both. Both my tweets, social media go on both. I contribute a lot, and I have a mission out there from pretty famous people. So it won't be, it will be time well spent. It's easy, it's secure, you're not sharing any information, you're just seeing what I contribute. If you trade, my input on social media is definitely worth your while. I also want to give you an email address, sellspreads@gmail.com. You can reach me anytime. So if you have any questions we can't get to today, please don't be afraid to send me an email. I respond to every single request. So before we get started, I always like to make that known, because sometimes you think that there's a talking head in front of you and you can't, once they're off the screen, boom, they're gone. Not so. I follow up on every request, every question, every comment as quickly as I can. So why should you listen to me? The proof is in the profits, as they say. Over the years, I had over 32% returns, and it's in a public portfolio, so it's like I can't mojo these numbers. I'm not pulling them out of a hat. They do exist, and I also have a 90% percentage on the credit spread trades that I do. So basically, it's high yield. I mean, 30% passive with low risk trading strategies, the way I do it. I'm not sure why this jumped around. Anyway, so brings me to the agenda part, and the agenda is going to be really simple. 4 bullet points, the first of which is going to be option spreads, credits, and credit spread basics. Now here today, because of time constraints, I'm going to make a few assumptions. Mainly, I'm going to assume that you've all looked into investing and you all know the basics of investing. So I'm going to touch up really quickly at what are spreads and how I can put them to work for me. So the agenda is going to be 4 bullet points, like I said, the first of which is option spreads and credit spread basics. Trading ranges. I know it doesn't sound too clear for you now, but it will be clear later. Ranges, trading, so just it gives you an idea. Managing the trading that you do within those ranges, and then my go-to strategies. So basically, I'm going to show you this bullet point right here. Do I have it set on self-dependent? Okay, this right here tells you what I do. Okay, this is the part that I do. Ranges is where I do it, and managing is how I do it. You can't just put a trade on and not manage it. Not all trades are perfect. And then I'll tell you the go-tos is what I like. Okay, my favorites. So write this down actually if you want. Leaving today, I want you to say, that's my goal. I want you to say, man, I can create consistent income with trades that only have 5 to 10% chance of loss. Then I need to learn a little bit more about this. That's the main idea. I want you to be curious enough to want to learn more about this, because it did me a lot of favors, it did a lot of my friends a lot of favors, and I think it can help you as well in your trading. So that's the basic agenda. So there's no better time than to just jump into bullet point number 1. We're going to see the option spreads and the credit spread basic. Now I know you all know how to invest. You buy a stock, you wait until it goes up, and then you sell it for more than what you buy it for. Therefore, you create profits. All fine and dandy. There's an easier, well, not an easier way, there's a way where you can get more bang for your buck. And that's called options, right? You've all heard of them, options. Those are not stock options that you get from your company but by working there. Those are option contracts on every stock. Every stock has an option contract. So this is a random Google old, I just didn't want to update it. It's because it's not part of the point. The point is there is an option spread out there, contracts that are offered where instead of buying a stock, you can buy a contract called a call. And if the stock price goes up, that call also goes up in price, and you can profit. And usually it goes up a lot more than the stock itself, percentage-wise. And I'll give you an example. Here is a snapshot of a certain day where Google was up 2% in one day. But that's great in one day. But had I invested in a call spread, that same day, I would have been up 50% almost. So this is great. This is way better. So bang for the buck, percentage. If I invest X dollars, it's going to be, I'm going to get 50% return in one day versus the 2%. And also, it would be like if to buy a $500 stock or a $1,000 stock at the time of this, you would need a lot more capital. Buying a call is a lot cheaper. Buying a spread is definitely a lot cheaper. So with hundreds of dollars, you can turn them into thousands of dollars, and thousands of dollars, you can turn them into $10,000. So it depends on your bucket that you're starting with. It is dangerous, but so is buying the stock. So here's the thought I want to put to you. When you buy a company, you're at risk immediately. You're immediately at risk. It can start going down and you start losing money, and all of your money is at risk. Theoretically, it can go to zero. We all seen it happen. You've got GM, Ford, they all went to zero. GM went to zero if it wasn't for the government bailout. A whole bunch of other banks went to zero. Big banks, we're talking Bear Stearns. I mean, come on. So it does happen. So all your money is at risk immediately. So there should be a better way of doing things, and that's why you do options. Then your money is limited. The loss is limited. Yes, you can lose all the money you invested, but it's hundreds of dollars versus, $50,000 to buy a bunch of stock of this guy, for example. So you limit your profit by doing the spreads, but that's fine with me because I'm limiting my losses as well. So the risk-reward balance still works, okay? So for me, the options are safer than buying stock because I can pick the level of risk. And the spreads within the options, by spread it means I do two options, buy one, sell one, are much safer than the naked options because if the stock runs against me, or stock price runs against me, I have one leg that's losing, but I have one leg that's gaining, so the total loss is a lot slower than it would be if I had just had the straight up leg. So this is a little confusing. It'll get clear. So this way helps me to focus on safer profits, so I pay less for my premium and then I risk less, but still with decent profit. 50% is pretty decent, right? This gives me better conviction. So if I make a bet, then I'm not losing my shirt in 10 minutes, then I have more conviction in my trade and I can withstand a little heat, which makes it easier to manage as a position, right? So having said that, so I can, here the theory is I bought this yesterday and today it's 50% more. I could sell it and make 50% on how much I invested. That's the simple way of looking things. Now what if I tell you that there is a way I can flip this around to where I can create constant income with about 5% chance of loss, right? That's pretty exciting. So that's what I do. And in comes the credit spread. This is just a regular spread. Credit spread is the same thing, only instead of buying this, I sell it. So I sell the spread, and if price stays away from the level where I sold it, I get to keep the premium. I become an insurance salesman, basically. I get paid to put the trade on. The other one, when I put the trade on, I pay. Here, I get paid to put the trade on. I define my risk. Okay, if the stock is trading at $500, I say I want to take a risk at $450. I define my risk, and I define my dollars at risk. You know, the maximum I can lose is X. I know exactly how much I'm going to lose if everything goes against me. It's low maintenance if you pick your levels right. And time is on my side. As time goes by, I'm making money because this spread that I sold is getting cheaper, and now I can buy it back for a lot less. So this will be I can choose my winning odds. What do I mean? If the stock is at $520, say Google now, 525-ish, something like that, and if I say, okay, I'm not comfortable with 525, I don't want to buy the stock, I can sell the spread under 500, so I give myself a buffer to be wrong. Google can play around between 525 and 500, and I'll be just fine. So you'll hear me say credit put spread. That's what I mean. I sell a put spread in Google that is gives me credit into my account. And you will have, you'll also hear me say a credit call spread. That would be a bearish trade. Credit put spread is a bullish trade. So if Google's trading right here at 525, I say I want to take it at, I'll sell the 500 and I'll buy the 495 puts. So that's a credit put spread. That means that I want Google to go up from there and stay away from my price of 500. So that gives me $20 or $25 buffer zone. Okay? So credit put spread is a bullish position. So these are the basics of the credit spreads. Now it has elements, right? You got to know what's involved. Elements of a credit spread. Risk size. I define X dollars. I want to lose maximum of X dollars. But that also tells me that I can only make Y dollars, which is fine. Risk position. Where do I want to put the risk? Okay, that's how much I'm risking. Where do I want to put the risk? Remember I told you at 500, for example, I use that for Google, okay, as opposed to it being at 525 currently. And then risk management, key. I can't just set it and forget it like Ron Popeil. And zero hopium. I got to be real. I got to test. I got to test my levels at all times, okay? So no hopium. If something is running against me, I got to act fast. Now, this sounds risky, but let me tell you something. I am the most conservative guy you will ever meet in your life. I'm the guy who's driving down the freeway and nicely paved freeway. I'm looking for potholes. I'm not enjoying the ride. That's me. And that's why I do credit spreads, because I can define my risk. And I'm in control. So when I risk position, gives me the conservative part. When I buy a stock, it's a coin flip. 50-50 chance I'm right. There's no doubt about it. Anybody that tells you otherwise is wrong. It's a 50-50 chance. Stock can go up, stock can go down. You know, I can be right, I can be wrong. With my style of trading is I can say, okay, I want that 50-50 to be 5% chance of loss and 95% chance of success, and that's what I do. That's because I position the trade exactly at 5% theoretical chance of loss. It's in my hands. I can do it. So this is where it gives me the right to pinpoint the right opportunities. So I can say, okay, I like Google, but I don't like it right here. I want to build myself a buffer zone, so I pinpoint the right opportunity that gives me, a 95% chance of success. Okay, having said that, that's bullet number one. See how easy it is? So buying stocks, good. Buying options, better. Buying option spreads, better than options naked. Selling option spreads, for me, it's better than buying option spreads because time is working on my side. Okay, having said that, how do I trade this stuff? Now we're up to bullet point number 2. Okay, and bullet point number 2 is, it's got 2 main points. I'm going to trade the ranges. First, I told you what I trade. Now I'm going to tell you where I trade it. But before I tell you where I trade it or how, I want to find out what are the ranges. I need to define them. Okay, you can't just willy-nilly start throwing darts. And then once I define the ranges, I have to find the trade that fit within those ranges. So sounds confusing, but it's nothing but, it's basically here in number 1, I'm developing a macro strategy, the big picture, the world, the global picture. And here I've become micro, right? From the world, okay, the world looks like it is right now. This is my opinion of the world. Where can I do Google and Apple and the SPX and the NDX and the RUT? So that's the micro. I look at the big picture. How can I fit those trades of those particulars within it, right? It's pretty simple. If you don't do these 2, then you're just throwing darts. You're just, throwing it against the refrigerator and see what sticks, kind of pasta style. So let's jump into this 1 here, right? So 1 is define the range. I start with the macro thesis. I have to find out what the world looks like today, and I'll talk you through mine. I want to look at potential safety nets. What do I have? I've got the feds. And by feds, I mean the world feds. Everybody's printing money everywhere. There's a safety net. They told us over and over. The message has been so simple, yet people have been ignoring it for so long. The message is very simple. We're here as long as you need us, period. I'm going to look for pitfalls. This week, it's Ukraine. So I've got to watch out for that. Also this week we have some economic data coming out. I think it'll be better than expected, or at least in line. Then it's not much of a pitfall there. But people are pricing in some pretty scary stuff, especially last Friday. I think they're wrong, hopefully. Number 3 would be to look for warning signs. Warning signs is degrading economic data, spiking inflation, because now the Fed's changed the 6.5% unemployment to inflation. So you got to look for warning signs and keep it in front of you. And then you got to think globally. You can't just look at the United States. You got to look at Europe. You got to look at China. You got to look at Japan. Japan needs to start printing money so that the yen starts falling, so that it stops killing our markets. Yen is rising, the TLT is rising, which is killing the markets. It's tick for tick inversely related. Look it up, you'll see it. And the 10-year falling with the market. So you got to think globally, the whole picture. China, is it still growing 6.5, 7.5? Is it come out? They're going to come out and say, oh, we're tightening. So you got to think globally. And if you can't, just follow somebody that does. Follow me on Twitter. I update this stuff every day. So if you haven't written it down yet, I'm at RacerNick on Twitter. Test, retest, and test again. You got to challenge yourself at every corner, okay? Every corner. So this is the macro level. From the macro level, I go to the micro level. Micro level, I got to develop a micro thesis for every ticker. So that means I got to, maintain a watch list. Maintain a watch list, not have a watch list. Have it and look through it. I look through my watch list at least 2-3 times a day, but that's what I do all day. So I run through it. I see where it's at, how it's moving in relative to its competitors. I keep up with their news, etc. You got to run through it. It's really crucial, really crucial. And then you've got to use a penalty box. If some stock is not acting right, you don't have to invest in it. You don't have to, just use it. Cash is a trade. If you're afraid Friday, go to cash. It's a trade. And you got to avoid, don't ever trade around catalysts. Like if somebody's reporting earnings like Apple, I'm out until after the earnings. I'll put a big trade after the earnings because the earnings is a coin flip. I don't care what you tell me. You can do all the homework. You can nail the exact numbers they're going to deliver. They could hand you their P&L ahead of time. And you can say, oh my gosh, they hit this, they hit this, they hit this. You will never know how the market reacts to those numbers or the words. And one time they sold Google $100 because of the number of words that Sergey said. That was his first time back because he said 137 words or whatever, and they thought it was too little. They sold the stock. Okay, so here you basically, I'm telling you, you need to know what to trade. That's what I mean. Know what to trade, right? Macro, then hone it down to micro. And then, so what can we do, right? So what can we do as far as once we get those two components down? This is the market. You got bullish, bearish, and going nowhere. Credit put spreads, like I said earlier, you do them bullish. Credit call spreads, you do them when bearish. And you can also do both at the same time to trade around stagnant ranges. So a bullish trade, again, is credit put spread, like I said. I like them 90 to 95% chance of success. And I add a hedge when appropriate, not every time. And I avoid catalyst. And again, test and retest. Very simple stuff. Here's an example. Apple. I know the guy before me is going to laugh at all these lines. All these lines mean something to me, but forget about it. Don't look at the lines. Just look at the candle chart. By the way, if your charts are not set to candle, do it today. So if I'm bullish Apple right here, right, at 525, believe it or not, this is not a recent one, but it's still at the same price it was at least a few days ago. And if I'm bullish right here, I'll say, okay, I'll take a risk at 490. I'll sell a spread here and wait for time. As time clicks, a week or two, I keep the money because Apple is not going down anytime soon to here. That's the way I do it. I deploy it in a safe zone. I give myself a buffer, okay? It's very easy. And conversely, if I'm bearish something, I'll do a credit call spread and 95% chance, again, 90 to 95%. Hedges, no catalyst, test and retest over and again. Here is Google, for example, okay? Older chart. Again, I don't want the timeline to be, the theory is the same, right? I saw it overextended here, say, look, it's butting up one time, two times, it's not breaking this trend, so I'm going to go and risk my money over here. So I'll give a buffer, I'll do a credit call spread, right there, and if I'm confident enough, I see that it's defending this line well enough, I'll do another credit put spread down here, and now I end up with an iron condor because I have this one and that one. This is called an iron condor. All I want to do is Google to stay in here, and I keep both, and I almost I give myself a chance to double. But sometimes it's not. It's very clear that it's a bearish condition. This is Google another time. Head and shoulder. You've heard that before. Bearish. I expected it to go down. So I did a credit call spread, but no credit put spread. And that was a clear signal to go short Google at that time. So this iron condor is how to trade a stagnant trade. I can do both credit put and credit call spread at the same time. The overall chance of success is 80, but really it's 90 because you can only lose on one side of the trade. You don't need to hedge much. You can via shorter term, but it's hedged already. If stock goes up that way against the top one, the bottom one is benefiting, and then when it goes back down, it's the opposite. So it's kind of self-hedged. No catalysts. Don't try to outsmart the market. It'll bite you. Okay, here's a steroid version of the spread as far as stagnant trades. Priceline reported earnings after the close, that one day, right? And then the market ran it up to this place and then ran it down to that place in seconds. So that gives me something to shoot for. Next day, stock opens right here. So I said at the open, I sold up here and sold down here. So I knew that this is where they wanted to play. I said, you know what, I'll risk it over a day. And I sold the credit spreads, credit call, credit put spread, and then it did this, and then at the end of the day, I closed it for pennies. So I made, you know, all of my money in hours. I took clues from this and from that, and I did it. I didn't get greedy. I picked my levels of success. I didn't pick them here and here. I went out to here and here, okay? So that's just a steroid version of to show you how to trade the ranges. Another one would be last year. Let me see here. This is a good range to trade. If you see it like that, then you can do it here and here. Give yourself room to be wrong. Here's another one that's RUT. Sorry about that. RUT, that's the small caps all of last year. I mean, that's a beautiful range. I did it all year. Up here, up here, up here. You can do it all the whole way up. These are trades on the Nasdaq. I'm just showing you where you can put trades. Like right here, the Nasdaq, you can. I did put vertical and a call vertical. So and they paid me $2.60 and $1 times. If I did 10, that's 1,000. If I did 10, that's $2,600, and they all were successful. And within a couple of weeks, then you made all your money, most of your money. Here, right there, I went bullish on it for 30 cents, so that's $300 for 10. Okay, and here another, almost $2 on a play, and here you got 90, 30, 35 cents times 10 times 100, so it's consistent and available at any point in time. So this is how you can, the opportunity is there. Okay, so now we've done what I trade, where I trade it, right? And now we come to the third bullet point, which is managing the trades. Managing the trades is very crucial, right? Because you can come up with the best of trades, but if something goes wrong, you're going to get ruffled. So first, what is risk? Risk is two things. You got dollars at risk, right? How much can I lose maximum? Risk management is key. People don't concentrate on it enough. How much money I can lose. And the other part of the risk, what are the chances of me losing money? So what are the odds of me losing money? So how much I can lose and what are the odds of me losing money? Sorry about that. I'm trying to write with the mouse, left-handed no less. So that's really important. If I know the answers to these two, then I'm doing well. You're way ahead of everybody else. Okay, scalp, that means take profits when you can, especially in the momos. Momos are momentum stocks like Netflix, Tesla. You know them. They're in the news all the time. Up 5. Oh, Amazon down 10% yesterday at one point. You've got to, when you place a trade, you got to close at preset targets. If you say, okay, if I get 30 cents out of the trade, I'm closing it. Close it. Don't get greedy. And I almost never let the credit spread go to full turn. I always buy it back when it's cheap. I don't want to lose the whole trade over stupid pennies. If I'm wrong, I'll book the loss. Booking losses and leaving money on the table are part of being a successful trader. Do it often, practice it. What does that mean? Practice doing it. If you do it, then it becomes easier to do because it is the right thing to do. It's not the perfect thing to do, but it's definitely the right thing to do. And then when you're wrong, admit it, move on. Don't try to save a broken trade. If the trade is almost wrong because you need time, just give yourself more time. You can always adjust it, and that's a different conversation. Here's an example of booking profit. This is a real trade from a while back. I entered the trade on this date, and then on this date, and then just 4 or 5 days later, I got 60% almost of the maximum money I can make. Guess what? In 4 days, boom, I'm out. Thank you very much. I'm not going to wait around for the rest of the money. I left money on the table. I left 12 cents times however many, 20, so $240 on the table. But I made 320, and I'm in 4 days, so I'm happy I got out. And I never sweat it. I mean, it was an easy trade. Otherwise, like I said, it's not the perfect thing, but it's the right thing to do. Okay, so part of managing the trade, this is taking profits. Part of managing the trade is also knowing how to pick levels. Here's Apple a while back. It was down to $400 and some, and everybody was freaking out. So how did you trade it at 410? Did you say, oh, this is the bottom, I'm buying? Well, what I said is, this is darn close to the bottom. I want to buy it, but I'm not going to buy here. I'm going to sell a spread down here and give myself a buffer zone, right? You know, my buddy would have bought it here and I'll buy it here and I'll put a tight stop. I'll put a stop at 400. Okay. So if you bought it with a stop loss, then you lost money, because here's what happened. So it was the right thing to do, because just days later it rebounded. So that person was right buying it, but he got stopped out at a loss. But if you build a good buffer and you sell a spread down here, you can withstand that heat, right? So that's what, don't throw darts, pick levels, and manage with a good buffer so you can manage it easily. Another part of the managing the trade properly, other than picking levels, is hedging. Always consider hedging credit spreads. I always look into it, but I don't always do it. Sometimes I'm so convicted that it's not going to go like here. Even when it went down to here, I opened a huge position in Apple at $350, and it just never got close. 380 something was the bottom. So I went on in public and I said, this is it, I'm going all in, and I did. So always consider it, but not always do it. Don't hedge every credit spread trade. If you have good conviction, move on. And do consider the overall portfolio. For example, if I'm long Google, I'm long Apple, I'm long this, and I'm long that, and I don't have anything short, so I have a lot of long exposure risk, I'll short the Nasdaq a little bit with a credit call spread. This way, if I'm wrong and it starts running down, you know, those other long positions are losing, but the position I just added starts gaining. It just offsets a little my losses. It just makes it easier to manage, to stand my ground, right? And use options to hedge for, if you own stock, if you own Apple or Google, and you want to protect yourself, then you should buy protection via options. And you can do it for free. If you don't know how to do it for free, or if you don't know how to create your own dividends out of stocks you own, hit me with an email. Trust me, it's so easy to do at no cost and almost no risk. As a matter of fact, some of them are no risk of losing money. It's a win-win situation. So hit me at sellspreads@gmail.com, or reach out to me through the messaging system on MarketFi, whichever is easier for you. So you can do that. Trust me, it's very easy and it's essential. Part of managing risk is also to actually manage risk. Some people say, oh, I'm managing a trade. Well, are you? Are you doing anything for it? Okay. Like I said before, close it early. Scalp if possible. Dare. It's not easy to spend money you think is wasted. It's very easy, hard. Close at preset targets, like I told you. Practice, right? Expiration. Maximum gains is when you sell a spread and it goes and expires for 0. That's the maximum gain. It's perfect. That's what we want. Here's an example I'm sharing with you here. I'll walk you through that picture you're seeing down here. Zero hopium. I mean, if you're wrong, close it. Don't hope. If your only thing you're hanging on to that this trade is going to work, that you hope things are going to turn around and you don't actually know why it's going to turn around, you should cry uncle. Crying uncle means you got to close it and move on. Close cheap risk. Yeah. Close cheap risk. Here's an example why. In January, this is a real trade I did in live. In January, I had a Google trade that was a winning trade with hours to go. It opened, it was under pressure, I was like, should I close it, should I not close it? It was about 5 cents to close, but I wasn't getting the close, and suddenly Google started falling. It was like, oh my God. So I threw out an order and I said, I'll pay 14 cents to close it, even though the mark was a lot cheaper. Not a lot, a few pennies cheaper. I said, I'll close it. I closed it. For some reason, it executed at 7 cents, you know, for half of what I wanted to pay. Thank you, whoever did that. So I paid $80 to close it. Minutes later, look how much it would have been to close. I pulled up the same window later. $1.60. That would have cost me $1,600 to close. So when I have a winning trade, I should book it. Don't leave cheap risk open. That was cheap risk. If I had left it open, I would have been, ooh-wee. Okay, so basically risk size, how much I can lose, risk position, I have to pick the right level where I put my risk. Risk management, I got to manage my risk. No autopilot, no Ron Popeil, zero hopium. Okay, so I have a question popping up here. So this is what we do as far as spreads are concerned, and if you do that way, then you're sure to not get yourself in trouble. My go-to methods, I already said them like 100 times already here in case you missed it. Credit put spreads on strong bullish conviction. Iron condors when bullish is medium, I mean conviction is medium, it's like maybe, you know, room. And for example, June trade, I'd like to say, okay, now it's 1963 SPX. I want to chance it at 1710 or thereabouts. So I'll sell a spread, put spread at 1710, and then I'll say, but you know what? Markets are nervous. I'm going to do a credit call spread at the high 1900s, so 1970 if I can get premium up there, 65, 60, wherever premium. So now I can, you know, give myself a little conviction, added conviction because I'm betting both ways. I rarely bet credit call spreads only. I rarely do that. Really not a happy thing to do. So with that, I can tell that credit spreads do work, okay? And they give me the opportunity to get some consistent base hits. I'm not swinging for the fences. I want to swing for the fences, my hit rate. That's it. I want to be a hit man because I like to be far from trouble. I'm conservative. I don't want the potholes. And it does create me cash flow, allows me to create some cash flow. Every trade, I put a name to it. Oh, this one's going to pay my car. This one's going to pay my house. This one's going to pay. This way, I make it tangible, so I don't get glib about it. So remember, today leaving, I want you to say, hey, I can find a way to create consistent income with trades that only have a chance of 5 or 10% chance of loss. I need to learn more about this. I need to learn more about this. So this is really important because it is the only way we can get better at things is just keep on learning whatever comes. Now, speaking of learning, if time, I knew that time was going to be constrained today, right? Because of what we are, you know, allotted time here. I can't mess around with that. I have to respect the people that follow. So what I did is I wanted so much for you to learn, and I have so much more to share about this and other things. So I made up an offer, the opportunity to learn for the next 2 weeks. Think of it like a 2-week-long session. If you join me and the community that I have of traders on MarketFi. MarketFi, excellent resource for traders. So much to learn there. I have one of the most popular services there. It concentrates on credit spreads. However, I do answer questions across the whole gamut of investing. I provide extensive market commentary and coverage across everything, twice daily, sometimes more, and on the weekends. My members can reach out to me 24/7. They ask me a zillion questions every day. You can ask everybody over there, and no question goes unanswered, and they usually get answered in minutes. And it is, I made it so, you know, $14 for a 2-week learning session where you can access somebody 24/7, somebody that knows what they're doing. If you're really serious about learning something, and it doesn't have to be credit spreads. I do concentrate on credit spreads, but I answer questions all over the map. Anything, you know, what do you think about this stock? I have a lot of members that follow me just to know where stocks are going, because I'm more concerned as to where stocks are not going, because that's where I want to sell the spreads. But if you do all kinds of trading, my levels will help you out. If nothing else, get this, if nothing else, for my weekly pins of stocks. What does that mean? Early in the week, when the market was up in the 1880 and everybody's saying, oh, it's going to break 1900, I said, 1862.5 looks like a good place to close this week. I pinned it. With 15 seconds to go in the market yesterday, it was at 862.8 or something like that, 1862.8. So I missed it by pennies from days ago when it was nowhere near that. The week before that, I missed it by even smaller margin. Same with Apple and other major tickers, IWM, RET. So if you're trading whatever, I provide pins on all kinds of stocks, and I do get special requests sometimes. You will have access to my daily updates, at least 2 a day. I mean, they're massive updates, and you should read them, and they encompass everything, the Crimea situation, Ukraine, global, gas, power, all. And you'll have access to my published articles as well on Benzinga. I contribute there. I'm also, you can attend my Tuesday morning guest appearances on Option House and Benzinga Effort there. So $14 is really an insult to what you get in return. And I can, if you don't see value there, I'll give it back to you. It's impossible for you not to see value, regardless of what type of trading you're doing. So I urge you to give it a shot. I would love to have you in there. You can interact with other traders as well. When I post something, anybody can make a note and comment. They do all the time. Jokes fly back and forth. Some people disagree with my trades, and we kind of josh each other that way. Really fun environment, and I think it's a can't-miss opportunity for anybody serious about trading in any environment. So I think I'm running against the time here. I'm not sure. I think I may have a couple minutes left. I'm not sure. So if the presenter wants to true me up as far as how much time I have left, and I can cover some more stuff that I kind of skimmed over. Okay, thank you so much, James. I appreciate it. Thanks, everyone.